the Giants fans can't believe it. This was 24-3 at the half.
Oh, my God.
This was 31-10 in the fourth.
Now, if you're a sports fan, odds are that you've seen this more than once, and that is the late game comeback. Usually it happens because the losing team failed to shift its strategic focus from offense to defense at a point late in the game when it mattered most. And when it comes to financial planning, the same thing happens all too often. But it doesn't have to. It's time once again to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. Let's face it, most of the messages that come from Wall Street, directly or indirectly, the financial media, and even many financial advisors are offense-oriented. Which stocks are hot, how to get the best return, how to grow your money. And that's all well and good for investors in their 30s and 40s who are in the growth and accumulation stage of retirement planning and need to focus on offense to a certain extent. But it's not necessarily the right message or the right strategy for investors 50 and over. For them, financial defense is key. The trouble is, because financial defense gets so little attention compared to offense, many people have really a lot of misconceptions about the very term. We're going to clear up those misconceptions on today's show in a way that, to be quite honest, could change your life. Joining us will be Peter Schiff and financial advisor Doug Ferris. But first, let's look at when the time is right to start focusing on financial defense and why. Now in sports, signs like these are usually most prominent late in the game. Fans know how important it is to protect the lead no matter how big or how small as the clock winds down, because in sports, as in life, anything can happen. Now a good coach knows that too, which is why he'll usually shift his focus to defense at that point in the game as his primary strategy for winning. Earlier, his focus was on offense because you can't win the game without putting points on the board. But once those points are up, a good coach knows that his number one priority must now be to protect them, to preserve the lead in order to achieve his goal, which of course is a victory. Making defense his priority doesn't mean that he's going to ignore offense completely. He'll still call plays designed to gain yards or to score touchdowns, but they'll probably be more conservative plays than he would have called when the focus was on offense a little bit earlier on. There'll be plays with a relatively lower risk of resulting in a turnover or somehow resulting in an outcome that gives the other team an opportunity to score. So that's how shifting the focus to defense late in the game works in sports. And also, of course, why it's so important. But what about your money? What about savings? What about investing for retirement? When is the right time and why is it so crucial? As to the first question, in my experience, the right time for most people is roughly in the 7 to 10 years before they plan to retire. That means around age 55 for many people, although it could be a bit sooner or a bit later depending upon your plans and your circumstances. As to why making the shift is so important, the answer is the same as it is in sports. Because the game changes. Specifically in the game of life, there are 3 important things that change for most people. Number 1. By now, you've built something worth protecting. In other words, you've hopefully spent enough time focusing on the growth and accumulation phase of financial planning, on financial offense, in other words, to have accumulated the foundation of your retirement savings. You now have assets to work with. Will they be enough to carry you through retirement once you factor in goals like in things like Social Security, required minimum distributions, healthcare costs, inflation, taxes, and all the other important details? Well, answering those questions is all part of preparing your defensive financial strategy. The second important change in the game of life that makes defense so very important is pretty obvious. You've gotten older. In other words, as you've been growing your financial assets over the years, another valuable asset has been shrinking, and that is time. It's important to accept that. Why? Because while incurring a major financial loss in your 30s and 40s can be a problem, it's usually not tragic. At that age, you still have the luxury of time on your side to make up for those losses. But you start to lose that luxury once you hit your 50s. Sadly, we've seen this hard reality play out twice, not once, but twice since the turn of the century. When the dot-com bubble first burst in the year 2000, the stock market fell by more than 50% over the next 2 years. When the housing market collapsed in 2007, it fell again by almost 60%. In both cases, it took 6 to 7 years for the market to recover back to its previous peak, meaning the market delivered zero net growth for investors for a 13-year period from 2000 to 2013. Which means if you were 60 years old before the first crash and had not yet shifted to a financial defense strategy, your portfolio was basically underwater all the way from age 60 to age 73. The third major change that makes prioritizing financial defense so important is that you have new goals once you're near retirement, different goals from what you had in your 30s and 40s. That may seem obvious, but it never ceases to amaze me how many people fail to take time to think about how their goals change as retirement approaches, or specifically, many times, what their goals are in the first place. We'll talk more about that in just a bit, and about how identifying your specific goals can help you understand exactly why a defense-oriented financial strategy can improve your odds of achieving them. But right now, it's time to welcome our first guest, Peter Schiff. Peter Schiff is an American stockbroker, financial commentator, radio personality, and author, among other achievements. He's a CEO and chief global strategist of Euro-Pacific Capital, Incorporated, and the host of the Peter Schiff podcast. He's a frequent guest on many of the top business and financial TV shows, and his books include Crash Proof, How to Profit from the Coming Economic Collapse. Peter, it's been a while, but welcome back to the show.
Oh, thanks for having me on again.
All right, now of course you're here, you do understand we're on Newsmax, right? And so we're pretty politically conservative here, and I know you're from Connecticut, and I know you went to University of California, Berkeley. So
Yes.
How does that all fit into being on Newsmax? Help us out here.
Well, just because I went to UC Berkeley doesn't mean I got indoctrinated with any of their propaganda. I was pretty much a free market, libertarian, Austrian economist when I went in, and I came out with my head on perfectly straight. Now I only make my summer home, though, in Connecticut. I reside full-time in Puerto Rico.
Ah.
Yeah.
Now, I'm sure that has absolutely nothing to do with income taxes. So with that in mind, what's that?
Yeah, well, I don't really pay any anymore, so.
Exactly, I understand completely.
It's good to be in Puerto Rico. Plus, it's nice and sunny.
And the weather's a little nicer in the wintertime. I get that. So briefly then, we just got past the midterm elections. Based upon the results, what do you see that changing, if anything? How could people react differently with their portfolios based upon that? Just give us your quick thoughts on that.
Well, I don't think it really changes much. I think the economy is a gigantic bubble. I think Trump was right as a candidate. The air is coming out, but since a lot of people don't recognize it's a bubble, they don't see what's happening. So I think we're headed to a recession. I think it's going to be worse than the 2008 recession, the one we call the Great Recession. I think the difference is with a Democratic Congress, I think the stimulus that we're likely to get will include a lot more government spending, and the tax cuts that we get next time will probably be targeted to lower income and middle income earners. So they will be more inflationary than the ones that we had before. I think the impact on the deficit will be even greater. I think as much debt as Trump has added during the first 2 years of his administration, I think it's going to be much greater during the second half. I guess the only good news for Trump is instead of blaming the recession on the Federal Reserve, he can also try blaming it on the Democratic House of Representatives, because I think the next election is going to be not about who gets credit for the booming economy, but who gets blamed for the bust.
Okay, so you're making a time frame prediction then that the bust will occur within 2 years. But is this the bust created by the Federal Reserve and all the quantitative easing and all the printing of money? Is that your primary thought as to what caused the bubble? Because I agree, we're in a bubble.
Yeah, the Fed is the principal culprit here. They've been blowing successive bubbles since Greenspan was around, and they blew up the dot-com bubble, and that popped, and then they blew up the housing bubble, and that popped, and now they have a bubble in everything. And this is the mother of all bubbles. And when it pops, there is no larger bubble that's going to take its place. So we're finally going to have to pay the piper for all these bubbles. And believe me, we've run up quite a tab.
So how much of a stock market drop do you think could occur when this next bubble bursts? If it's worse than 2008, heck, most people had a 50, 60% decrease in equity values during that time. Are you saying this could even be worse in people's portfolios potentially?
It could be. I mean, it certainly could be as much as 50%, if not greater. Certainly, there are a number of stocks out there that are going to fall a lot more than 50%, regardless of how much the averages go down. But a lot of it might depend on just how much inflation the Federal Reserve unleashes. Because, if they print enough money, they can stop stock prices from falling. But what they can't do is stop other prices from rising, like food, energy, and the basic necessities of life. And so I think to the extent that the Fed can conceal the decline in the stock market beneath a layer of inflation, stockholders are not going to feel wealthier. They're going to feel poorer. And I think if you want to measure stocks in terms of an ounce of gold, I think the decline in the real value of stocks is going to be much greater in this next decline than it was in the previous one.
Quite interesting. Well, you're preaching to the choir here. I can't argue with that. We need to take a commercial break. We come back, we want to talk to you more about why. And then I also want to talk to you about how you think that's going to affect interest rates when all of this unfolds. As you said, sometime, most likely in the next 2 years. And you stay with us also. We'll be back with more here on The Income Generation. I'm Dave Scranton. We're here with Peter Schiff.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
So then, why is identifying your specific goals a key part of creating a defensive financial strategy? Well, if you're a regular viewer, you've probably heard me make the point that, broadly speaking, everyone wants the same thing from their investments. They want maximum return with minimum risk. Now, while you're in the growth and accumulation phase of financial planning, focused on offense, for example, that might be an okay guideline for your strategy. But later in the game, once you've passed age 50 or so, it becomes necessary to refine the guideline by asking the question, maximum return for what purpose? This is another idea I've discussed on the show before, but it bears repeating because it's central to understanding why the shift to financial defense is not only important, but also very practical as retirement approaches. See, basically, there are 3 possible answers to that question. Goal number 1, for a future lump sum purchase, such as a second home, a larger home, a yacht, a Rolls Royce, anything like that. Goal number 2, maximizing your legacy. In other words, for those who really don't care, they don't need any more money themselves, it's really just about leaving the biggest inheritance possible for their loved ones. And goal number 3 is supplemental retirement income either now or in the future. In other words, money to suit your lifestyle and achieve your goals after you retire. Now, maybe your goals do involve buying a second home or living very frugally so you can leave all the money behind to your loved ones or a favorite charity. But in my experience, those aren't the kinds of goals most people have for retirement. I find that 9 out of 10 people, as a general rule, have simpler goals that involve devoting more attention to pursuits and activities that they didn't have enough time for while they're working. People want to travel more, they want to go out to dinner more, they want to pursue hobbies and interests, spend more time with family, children, grandchildren, spoiling grandchildren. If indeed you realize your goals do fall into that category, then it's time to ask another question of yourself, and that is, how do you want to pay for those goals? Is it by drawing money from a lump sum asset, by selling a portion of your investments? Or do you want to be able to pay for those types of things through regular retirement income? Of course, for most of the people with whom I work, the answer every time is pay for it through income. And since that's the case, I invariably ask them this question. Then doesn't it make sense to maximize your investment returns in the form of income with reasonable risk? That does make sense to most people that I talk to right away. But often it confuses them also. Why? Because of one of the most common misconceptions that people have about financial defense. You see, what Wall Street, the financial media, and many advisors would have you believe is that in order to increase your retirement income, you actually have to increase your investment risk. In other words, focus more on offense than defense. The reality is that the opposite is true, as I often explain using this formula. While some advisors like to use the terms growth and return interchangeably, the reality is that total return is a sum of two things. It's a sum of growth plus income. Growth, of course, is measured in capital appreciation, while income appears in the form of interest and dividends. Now, based on this common misconception of focusing on offense rather than defense, many people believe that in order to increase returns, you must increase growth. And that the best way to do that is by staying invested in the stock market, buy and hold, even in periods of high volatility and risk, such as what we've seen over the last several weeks. Thus, they believe, as I'd said, that in order to increase your income, you have to increase your risk. That's simply wrong. Why? Because when growth turns to shrinkage as a result of a major stock market drop, obviously your income can also shrink, as buy and hold investors have learned the hard way twice so far since the year 2000. And when that happens, it increases the odds that you'll be forced onto the slippery slope of spending down investment principal to meet your income needs. And this, of course, increases your odds of running out of money before you run out of life. And that's very much like blowing a big lead late in the game by mistakenly staying focused on offense instead of defense. So then, how does investing for income constitute shifting your focus from offense to defense? Well, to put it simply, when you're focused on income, you're typically investing in things that are contract-based, and strategies designed to satisfy your income needs through interest and dividends, while at the same time lowering your risk and attempting to protect your principal. So, while increasing your portfolio growth may require increasing your risk, in my experience, increasing your retirement income starts by reducing your investment risk. In other words, shifting your focus to financial defense. But the question becomes, what specifically are some of the options and vehicles that make up a defensive strategy? And what are your specific plays in your defensive playbook? In other words, what are they designed to protect you against? We'll talk more about that in just a bit, but right now it's time to welcome back Peter Schiff. So Peter, you know, how do you think interest rates are going to fare with all this? I know the Federal Reserve is desperately trying to raise rates so they have more bullets in their gun next time there's a recession to lower rates again. Are they going to get their gun loaded quickly enough, or do you think people are going to start shooting, the economy is going to start shooting at them before they do?
Well, that gun is probably going to backfire. I mean, first of all, the Fed is likely to keep nudging rates higher. They're oblivious to what's going on. They have no idea that we're facing an economic crisis worse than 2008. If you recall, they were completely blindsided by that crisis. But we are looking at a stock market decline, a housing decline. In fact, this housing bubble is bigger than the one that burst in 2007, 2008. In fact, it's already happening. Look at what's going on. The home building stocks haven't been this weak since 2007. The inventories of unsold homes are exploding. Prices are about to fall through the floor. The Fed doesn't understand how this is going to impact the economy, the reverse wealth effect, all the foreclosures, and the unemployment that will result from the collapse in the housing market. But the Fed will probably keep raising rates until they see the economy in recession, until they see the bear market in stocks and the collapse in real estate prices. And then they will do what they've always done. They will slash interest rates. They will launch QE4, and they will expect to bail out the economy like they did before, except they're going to be surprised because it's not going to work the next time. It's not going to be the third time's the charm. It's going to be 3 strikes and you're out. So what's going to happen with the next round of quantitative easing is the dollar is going to collapse, and the only prices that are going to go up are going to be consumer prices, the price of goods and services that Americans buy every day. And as the cost of living goes up, the American standard of living will come crashing down.
So in the minute or so we have left in this segment, 2 questions. Number one, how can the dollar collapse when a lot of the European currencies and so on, really they're in as bad shape, if not worse shape than us? So let's start with that question first.
Well, first of all, I mean, the euro and the dollar aren't the only currency out there. There are plenty of currencies against which the dollar can lose value. But I would disagree that the U.S. dollar or the U.S. is in worse shape than Europe. I think, that Europe's in worse shape than the U.S. I think we're in worse shape than Europe. And I think people are going to find that out. I think investors are too concerned about what's happening in the Eurozone or Japan or China, and they're missing the even larger problems here in the United States. So I think the dollar is going to be weaker than the euro, but I think both currencies are going to lose value in terms of purchasing power. I think the price of gold will rise in dollars and euros.
So Peter, 10 seconds. Do you think we'll get to negative interest rates in this country this time around like happened in Europe last time?
Well, we already have negative real rates. I don't know that we'll ever get to negative nominal rates, but the Fed will certainly go to 0. But I think they're going to lose control of the long end. And I think long-term interest rates are going to go way up, despite the Fed's
I think they're losing control of that already, absolutely. We need to take a commercial break. Stay with us. We'll be right back here on The Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. So when you adopt a strategy based upon financial defense, what specifically is that strategy designed to protect you against? Well, the main answer, of course, is loss. The more precise answer is loss caused by a number of specific things, some of which we've already mentioned. But let's go over the main ones and identify how investing for income actually can help protect you against these things. The obvious one we've touched upon already, and which I discuss frequently on this show, is market turmoil. We've already had those 2 major stock market corrections this century, and history, yes, does suggest, as you've heard me say many times, a third drop that could be even bigger than the last 2. By their nature, income-based strategies, namely bonds and bond-like instruments, are designed to be more insulated from market turmoil than our stocks and mutual funds, for example. Yes, the bond market also fluctuates, of course, but typically not nearly as dramatically or not nearly as rapidly and violently as the stock market. What's more, most income-based strategies are contract-based, providing some sort of assurance that your principal investment is secure if you hold it to maturity, and that it will generate income through interest and dividends at a fixed rate over that time. Your contract means that typically any loss in a diversified portfolio of individual bonds, for example, is a temporary paper loss. Why? Because you're guaranteed to get your principal investment back if you honor the contract, you hold it to maturity, and of course, the issuer does not default. In the meantime, the drop in value doesn't affect your income. Why? Because that income is also contractually guaranteed at a fixed rate. That's what makes investing for income a true financial strategy, as opposed to a gamble in which you simply cross your fingers and toes hoping to achieve growth and to avoid shrinkage. In addition to defense against a major market loss, investing for income is designed to better defend you from the risk of spending down principal, as I briefly mentioned earlier also. Spending down principal dramatically increases your risk of outliving your money, and many things can increase your risk of spending down principal. Those include failing to protect and to align your Social Security income with your overall financial plan, and not having a strategy in place to satisfy your required minimum distributions through interest and dividends once you turn age 70 and a half. Avoiding many mistakes related to those things is central to any income-based financial strategy, as is defending your money against another major opponent, and that is, you guessed it, inflation. Failing to adequately estimate and prepare for the impacts of inflation over a 30-year retirement is one of the most common mistakes that retirees make. Why? Well, it's partly because some may have an advisor who continues to promote outdated textbook rules and oversimplified concepts, such as, you should always keep some money in the stock market as an inflation hedge. Just ask those people who lost nearly half their savings in the 2000-2002 market crash, and those who lost more than half in the 07-09 crash if they think that stocks provided a good inflation hedge. The fact is, there are better options available once you shift your focus to income and financial defense. For example, some annuities let you purchase a set inflation increase in income, or allow an adjustable inflation protection based upon an outside index such as the CPI. Other investment vehicles can offer contract-based inflation protection like I-bonds, or non-contract-based protection such as commodities or dividend-paying stocks. In terms of healthcare inflation, which rises at a much faster and steeper rate than general inflation, long-term care insurance can also offer protection to help make sure your benefits don't lose their purchasing power over a long retirement. All of this gets to the heart of another common misconception about financial defense and investing for income. Because income-based strategies get so little attention, relatively speaking, most investors don't realize that these strategies, these very strategies, yes, they themselves can provide a highly effective inflation hedge. How? Because in many instances, the hedge can be engineered through the reinvestment of interest and dividends that you don't need today for current income. Here's the bottom line. Some retirement income sources are better protected against inflation than others. But collectively, I believe defensive strategies designed to generate income through interest and dividends can often offer better protection overall than most growth-based options. It all starts by recognizing that it's time to shift your focus from offense to defense. And then once you've done that, finding the approach and the strategy that's just right for you based upon your personal goals. As I always stress, a qualified financial advisor who specializes in financial defense and income-based strategies can help you do just that. Now, let's welcome back, once again, Peter Schiff. So Peter, let's talk about how our viewers, how our income generation members can strategize in an environment like this. What types of things are you recommending for clients of your firm, per se, in this environment if it's coming up really within the next 2 years?
Yeah, well, I've been preparing for this for a long time. I mean, it's been a long time in the making. The Federal Reserve has been inflating this bubble for decades. And, we almost, had to pay the piper in 2008. But unfortunately for the United States, the Fed was able to blow an even bigger bubble and kick the can down the road. And now we're catching up to that can. And again, at this point, it's so big that if anyone tries to kick it, they're going to break their foot. So what investors need to do is be out of U.S. financial assets. That includes stocks and bonds. They're both going down, and real estate, although if you're talking about residential real estate, that might be harder to unload. but it's certainly easy to sell stocks and bonds. And investors need to get out of the dollar. And that's what we're doing with our clients at Euro Pacific Capital. We are constructing portfolios of foreign assets, undervalued foreign stocks that pay good dividends. We're also focusing on gold and silver. I think these are excellent inflation hedges. I think inflation is going to break out worldwide, not just in America. It'll be particularly pronounced in America, but other nations are going to experience it. And so you need to have gold and silver in your portfolio. The precious metal stocks, I think, are important parts now of a stock portfolio. I think there's a lot more upside in the mining companies than in the metal themselves. So we have all sorts of strategies. I think the emerging markets, some of the stocks there are particularly attractive right now. In fact, I think what's going to be unique about this next recession is it's going to be particularly severe in the United States, but I think the emerging markets are actually going to see their economy strengthen as the dollar collapses in the U.S. recession, because it's been the strong dollar that has been hurting the emerging markets, and they're going to get relief when the dollar falls, and that's going to be a big tailwind for their economy.
So, Peter, so I could see, strategizing to say, okay, let's invest in other currencies and try to play that. But I guess the gold thing, I've always said I've got an issue with the gold thing. Nobody's really pegged to gold anymore in terms of currency. So is gold really still an inflation hedge? I mean, the reality of it is if the stuff really hits the fan, people need food, they need clothing, they need shelter. Who's going to be there to buy gold in that environment? And gold isn't really used in that much technology.
If you want gold, if you want food or shelter and you have gold, you'll always be able to buy it. Not so sure about all these fiat currencies. Look, gold is still a monetary metal. It is held by all the world's central banks. In fact, central banks are accumulating more gold. I think they're preparing for a post-US dollar reserve currency world where I think gold will once again be the principal reserve asset, and I think currencies will be backed by gold again, the way they were prior to 1971 when they were backed by the dollar, but they were indirectly backed by the gold because the dollar was as good as gold because it was convertible into gold on demand of the holder of dollars. But gold has been around for thousands of years, preserving purchasing power. It has survived all sorts of fiat currencies that have come and gone,
and it will survive? It's going to survive. Peter, unfortunately, we need to leave it there for now. We're out of time. Time flies when you're having fun. Thanks again for being on the show. We really appreciate it.
Okay. Bye-bye.
Stay with us. We'll be right back with more here on The Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. Visit the Retirement Income Store at soundincomestrategies.com today to receive your free digital income kit. The digital income kit includes free reports, whiteboard animations, and an educational DVD, all packed with easy-to-understand information on how actively managed income-based investment strategies can help you achieve your retirement goals. Go to soundincomestrategies.com right now and click on the Income Kit tab to request your digital income kit absolutely free.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. If you tuned into our show last week, you might recall that I made a point that while there's never a bad time to shift your focus to financial defense if you're after the age of 50 or so, sometimes can be better than others. And I believe that right now is a very good time, economically speaking. We live, as I often say, in an unprecedented age of economic uncertainty. History suggests, and many experts agree, such as Peter Schiff, that the stock market is long overdue for another major correction, on par with or possibly even bigger than those that already occurred twice in the century. Volatility returned to the market in a big way in October. Why? Despite strong economic data, Wall Street knows that there are ominous factors in play that could serve as the tipping point for that next major drop. Worries over the ongoing trade war with China, the Federal Reserve's moves on interest rates, moves on inflation, a housing slowdown, falling oil prices, the still soaring federal deficit, just to name a few. With the market overvalued, but still currently less than 10% down from its record peak, and with all those brewing uncertainties in play, I believe all those factors make this an ideal time for investors over the age of 50, members of the income generation, to make that shift from offense to defense. By doing so now, you're not only making the shift to defense at the right point in the game of life, you're also smartly practicing the first rule of sound investing, and that is buy low and sell high. Why? Because while there is always a chance the market could get back to an upward trajectory and climb another 10, 20% points above its previous peak, there's probably a bigger chance, based on all the uncertainties, that it could tumble into that next major correction instead. As I also pointed out last week, history indicates that the next drop, yes, could be as steep as 40 to 70%. So compare a possible loss of that magnitude to a potential gain of 5, 10, or maybe even 20%. And then consider if the risk of staying focused on offense right now is really worth it. Frankly, that would be like a football team calling a risky play to add points that they didn't really need while knowing that a turnover could cost them the game. It doesn't make sense because most people, including football coaches, are wise enough to know better than that, to take a risk when the potential loss outweighs the potential gain. They're wise enough to focus on defense when that's what gives them the best shot of winning the game. And when it comes to the right financial strategy for baby boomers in or nearing retirement, what's true in sports is true in life. Now, speaking about football coaches, let's welcome our next guest, Doug Ferris. Doug started his career in the early 1990s at New York Life, where he was named Rookie of the Year. From there, he moved to Prudential Financial before co-founding Key Advisors Group in Lewis, Delaware in the year 2000. Since then, his firm has helped hundreds of hardworking Americans meet their retirement goals using sound, personalized financial strategies geared toward protection and income. Doug, welcome to the show.
Yes, sir. Thank you, Dave. Good to be here. I loved your sports analogy.
Well, and for someone who coaches high school football, tell us, aren't there a lot of tie-ins between sports and coaching football to coaching people on how to invest their money?
Oh, there absolutely is. I mean, that's really what we do every day is we coach people. And, I actually love that word as a matter of fact, too. And,
Sure.
We want to look at ourselves more as coaches and advisors, versus the standard stockbroker stigma for sure. But yes, absolutely. We're very much into the coaching of our clients.
So, it's funny. You could be ahead by 4 touchdowns, 2 minutes left, and, the offensive side gets the ball, and, they still want to throw the ball down the field, and they still want to they want to win by 5 touchdowns. So you need to sit there and tell them, whoa, timeout, guys. We're going to do some running plays. I don't want to see that ball leave your hands. But isn't that same urge true with a lot of investors that you talk to on a regular basis? They have so much fun racking up that score that it's hard to make that shift from offense to defense?
No question about it. And unfortunately, it's a normal humanistic, it's nature is what it is, and it's greed. And I hate to use that word, but there's a little bit of greed out there as the markets continue to climb over the years. We have this obsession with just thinking that the markets are going to continue to grow each and every year. And you and I both know that that just is not going to happen. And we've got to be able to coach them properly and at least have our eyes open for the downturn of the markets. And as you like to say, Dave, is get defensive. I think that plays a huge role in anybody's portfolio that's over the age of 50.
So Doug, we have about 20 seconds left in this block. How do you psychologically help people through that change?
Well, I make sure they understand that, and I'll ask them this question: can you afford to lose X amount of percentage or X amount of dollars out of that portfolio? And if the market does collapse or even has a short collapse, how are you going to react to that? So I like to coach them by asking them that question, and they pretty much answer their own question. And of course, that helps us lead into some type of defensive
Just
position.
like a good psychotherapist, right? They don't tell you anything. They just ask you questions. The answers are within all of us. Stay with us, Doug, and you stay with us too. We'll be right back here on The Income Generation. Welcome back to The Income Generation. You're here with David Scranton and Doug Ferris from the great town of Delaware.
Yes.
Actually, Doug, I'm sorry. I just offended I just offended.
Delaware is a state, Dave.
I know I probably just offended, what, 60, 70,000 people all at the same time, and I apologize for that. That's not very nice of me. I'm just kidding. So, it's interesting because you're in a similar market to me. I'm in Connecticut, so you're only one of 2 states smaller than Connecticut, so I get to pick on you a little bit. But, when people come to see you, they're nervous. Are they nervous about the markets right now, or are they confident? Are they confident that the president's going to be able to push this economy to the next level?
I got to say, we do have a mixed bag of both, but I do want to tell you that if they're not nervous about the market, we're not here to make them nervous about the market, but we certainly want to educate them that there's an opportunity, unfortunate, that they may lose a lot if they're heavily invested in the market. So I think it's a mixed bag of both at this point.
So it's really not whether the market's going up or down. It's really that, look, if you can't afford to lose it, play defense, not offense. Period, the end, common sense.
Absolutely.
So, okay, what kinds of strategies do you typically recommend for your clients that are part of the income generation, that are 50 and over, let's say within 10 years of retirement? What types of things?
Well, obviously, it comes down to really doing a very, very good fact finder and understanding the client's needs and wants. Not only current needs and wants, but possibly future needs and wants as well. And then once we determine what type of assets that they actually have, we look to put a certain percentage of those assets into a defensive position, whereas if the market does have a huge turn down or even a slight turn down, they're not going to participate in this turn down of the market itself. And again, so why take the chance and why take the risk if they can't afford to lose it? And that's really how we look at this.
And not to mention the fact that, in the last 2 drops, a lot of people felt like they were victimized by the stock market and maybe some by the insiders of Wall Street. Well, the reality is this. By putting some money in conservative things, next time the market drops, they can become capitalists. They've got money in more conservative stuff. They can shift into the market and take advantage of the fact that it's on sale at that point. Do you talk about that a lot with people, as I do?
We sure do, Dave. And, it always brings me back to, unfortunately, 2008. I can remember watching the television and seeing these folks that are really going through an unfortunate time. But I remember one gentleman in particular who said he's been retired for 6 months and now he lost about 40% of his assets and he has to go back to work. So my first thinking, of course, thinking as a financial advisor, is number one, either he was ultra greedy or he had some very poor advice. Now, you feel bad for them, but I think that is greed at that point in time. As you know, we've got to lean a little bit more to the liquidity side and a little bit more the conservative side the closer we are to retirement.
And it's hard, as you know, when everything else you read and hear about is about offense, how to grow your money, it's hard for the average investor to know what you're talking about. But Doug, thanks for being on the show.
Absolutely.
And you stay with us here. We'll be right back with more on the Income Generation. I'm David Scranton. I'd like to thank both of our guests for joining us today for another episode of The Income Generation, but I'd also like to thank you, our new and returning viewers. We've all heard the old expression, nothing ventured, nothing gained. And there is some truth in it. But don't ever let yourself be fooled into believing that it means the same thing as another common expression, and that is, the bigger the risk, the bigger the reward. Sometimes that expression can be true, but it often isn't. Sometimes the outcome of a big risk is only a relatively small reward, weighed against the potential for a huge loss. In my experience, most people wouldn't take a risk like that. They know it's impractical. They know it's even foolish. The trouble in the financial world that investors often don't realize is that this is exactly the kind of risk that they're taking in real life. Oftentimes people don't realize that in an overvalued market like the one we're in right now, they're chasing an additional 5 to 10% gain at the risk of potentially, as Peter Schiff said, a 40 to 70% loss. And if they're over the age of 50, they don't realize they may be jeopardizing their entire retirement plan by still focusing on offense at a time when they should have shifted their strategic focus to defense. It's unfortunate when people make this mistake, but it's not surprising when you consider how little attention is paid to the importance of defense compared to offense in this Wall Street-dominated financial media. Probably 90% of what most investors read or hear is all about maximizing return and growing your portfolio, while only 10% or less is about how to protect your downside. And as a result, people have a lot of misconceptions about financial defense. They don't realize, for example, that shifting your focus to defense doesn't mean you're completely abandoning offense, and that you can indeed continue to grow your portfolio organically through defensive strategies. They don't realize that since total return is a sum of both growth and income, that reducing your retirement income actually requires decreasing your investment risk, not increasing it as many advisors would lead you to believe. And they don't realize that for most people, income-based defensive strategies are better aligned with their retirement goals than our growth-based strategies. And that makes shifting your focus to income and defense not only a smart strategy for meeting your retirement goals, but an extremely practical one. You can learn much more about financial defense and investing for income in my book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. And of course, by tuning into the Income Generation right here every Sunday morning on Newsmax. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's absolutely essential you stay informed and up to date. And yes, right here is where you can do it on the Income Generation. I'm David Scranton. Thanks again, and we'll see you next week.